Okay, welcome. Weekly Roundup, June 24th, 2022. Racing into summer because summer's here, literally here.
It is
We're in
literally
summer
here. It's
this
true.
week. It's feeling like it. Heat's it can't decide, right? It goes cold and then for a few days, then it goes super hot. So yeah. But and segue, market seemed to be heating up today, didn't it?
Seem to be, yes. Yes.
That's your cue to take it. Segue.
Yeah. Take it away. Take it away. Equities, I guess. Crypto, equities, tech, growth. They seem to rally today. It's all I think the good news for a lot of the stuff we own is bonds have rallied since last Tuesday. And so because I've had lots of conversations this week, and I'm trying to, talk a little bit about that because we've been talking about it for months now. And from Tuesday of last week, which it looks like we kind of hit the highs of yields and the low of prices in bonds. Bonds have been rallying since then, and so the U.S. 10 years up about 2.5% since then, and long bonds are up kind of 4% since then. So, some people say that's because of oil selling off. I think it's probably a combination of oil selling off and a combination of what Powell said and also what the economy is saying. So, I think good news. I'm seeing that positive direction in bonds and some of the growth stuff like KWEB, which I've talked about, which is Chinese internet stocks. We're up 6.5% this week, so they had a good week.
Good.
Yeah.
Good stuff. So did that being said, you get up to anything in the portfolios this week, or kind of hurry up and wait, or what are we doing?
Yeah. So I think not anything material from a change perspective here. It's more of a revisit the positioning, go through why and what, and if I'm still happy with everything in there. Spent a lot of time going through companies and looking at their businesses. A lot of people look at the kind of the earnings number, that price earnings number, but earnings have been coming down hard. So I've been trying to dig in and look at the earnings numbers and saying, do these still make sense? Obviously, growth companies react much better to lower interest rates, so that's a real positive. So, I think spending time saying, are these growth businesses truly bottoming with Shopify down 70% and Coinbase and some of those names, are they truly bottoming? And so spending a lot of time reading through that stuff right now.
Gotcha.
Yep. Yeah.
Was there anything in the news that grabbed your attention this week as far as the economy is concerned? Anything big happen?
Yeah, just really the difference between what the Fed chairs are saying versus what is actually happening. So like in my daily today, which you saw, Bullard said we're in the early phases of an economic expansion. Like, I think this guy's completely out to lunch.
That's what you really think, Ben.
Yeah.
Jeez.
Well, look, sometimes we all look to these central bankers as the ones that know what to do and how to do it. And Bullard is one that's actually never had a job outside of central banking. So not that that's the only way you should grade people, but kind of understanding the economy, working in the private sector sometimes, but it gives you a better feeling for what's actually happening. And so as we look at the data, and I'll go through some of the numbers, some of the things in the slides today, but everything that I've said, Michigan sentiment survey is as bad as it's been anywhere in the world. You look at kind of around the world, sentiment is terrible. Look at jobs are being lost. Like a lot of companies are starting to cut now. You're seeing layoffs, kind of 10 to 15% layoffs in a lot of the tech companies. I talked to someone in HR from San Francisco a couple of days ago, and they said the market there seems to be really soft. It's not a lot of jobs there. Housing market's rolling over. I mean, there's kind of everything you want to talk about. The consumers tapped out. Credit card debt in the U.S. is 1.1 trillion, as high as it's ever been. And you're starting to see everything slow. So I don't know what they're looking at.
Yeah.
Something in the rearview mirror. And so As I go through, actually, I listened to Luke Luke Gorman talk today. He's a research guy, Forest for the Trees. Interesting kind of view on where things are going. And, he thinks that when he started the year, he thought that Q3 would be when the central bank pivoted and went from kind of holding rates to potentially cutting rates. And his views this week are he thinks it's much sooner than that. So maybe late summer. So hard to believe today when you look at the research, they're talking about 7-8 rate increases. But I think that, with the data slowing as fast as it is, there's a greater likelihood that that they go on pause sooner than everyone thinks.
Gotcha. Okay, well, we're gonna keep it tight today, so let's jump right into the charts, Ben's charts segment.
Sounds good. Let's get it popped up here.
As usual, if anybody has a question, just pop it in the question bar there. Happy to relay that.
I had a few come through, which I'll comment on after we do this, but
Okay.
yeah. We had they've got a new guy at Hedgeye, only been around for about a year and a half there. Put out some interesting stuff today, which, central banks continue to be a major linchpin in how things play out here. So I thought this would be important to think about what's happened so far, what's expected, the calendar of how that looks, and then kind of why that's relevant. So if we look at this is central banks throughout the world where, Russia, obviously that's a standout. They've raised 1,000 or 10.5%. But this is all in basis points, and their stock market's down 65% since they did that. Maybe other reasons besides just the interest rate increase, but
Right.
certainly relevant. Sweden, New Zealand. Ultimately, you look across the board there, with the small exception of Switzerland. All of the markets have sold off with the rate increases that we've seen so far. And so, the question is, how much further do they go? Is there a correlation between these two things? I think the answer is yes. The stock market at least has started to say to us, well, we think that the economy is struggling. We think financial conditions are tighter, so these companies can't grow at the same pace they're growing. And so I think it's interesting to see what's happened since the start of the year, and it's all kind of driven off of this rate news.
Right. Interesting.
So just a slide on what's next. And so this is a U.S. market pricing in another 25 basis point increase by the end of this year. And like I said, the more and more I look at the information, the more I think that this is going to be concerning. And one of the big things that I've said before, Powell, comes from private equity. And private equity only exists when leverage is allowed in the system. And so high yield issuance in the US this year is down 75% year over year. And if you look at corporate issuances, it's down about 10 or 12% this quarter. And the spreads on high yield is kind of north of 500. And as you start to reach these levels, these companies can't finance themselves anymore. And so I think this is something that would cause a big concern. 5 more hikes in Canada. Again, I talked to a couple of real estate agents this week, just got a feel on what's happening in the market. And, they went from like just fighting each other for listings to boom, like they got 30, 40, 50 listings overnight, and they just can't sell them that fast. And people want a price that they could have had 3 months ago, which doesn't exist today.
Yeah. The funny thing is how they're going to react to that, because still the price they're going to get is going to be astronomical to what they would have got 3 years ago, right? So it'd be funny if they're going to hold out. People are going to hold out and say, no, I want that price I was going to get 3 months ago. Because the reality is, if they want that, they may end up waiting 5 years to get it, right?
It's same thing with stocks, right?
Yeah, exactly.
They want to top tick the stock. So
yeah,
Yeah, I mean, I think that there'll be a mix, but I just from experience on this side of things,
Hmm.
I think you're going to have more people believe that they can get that top tick and wait.
Agreed.
Yeah,
Agreed.
so
Yeah,
that'll be interesting to watch for sure.
it will.
Yeah, and I don't have to go through all of them, but it's just a sense that the world is tightening. And really, I think that, I get this kind of two-pronged question is, have we seen the worst of it yet? And what does it mean with it from a rates perspective? And so this is the outlook for when and how things are going to play out. So next meetings for North America are not until July. So Canadian meets in July 13th. So it's coming up pretty soon. Then July 27th for the Fed. So interesting. I mean, this is the number of hikes. So like in the box here where you get 2.8, that's not quite 75 basis points, but that's kind of what the market's pricing in. And in Canada, you got 3. So again, 75 basis point hike in July. You know, it's hard to believe that this will continue at this pace and the market will say okay. And I think that we're starting to see signs that there's pain in the market, and I think we're positioned to do quite well in that backdrop. And
Hmm.
so the bonds in the portfolio have picked up, as I say, starting to, and I'd expect that to continue for the back half of this year. But I think one of those unique points is, when are we going to see kind of that capitulation in equities? And that's a lot of the questions I've had recently. And I think the answer is soonish, but not quite there yet.
Okay. Did you have one
Uh,
more? Or?
One more, just
Yeah.
because this come up a couple of times this week as I spoke with clients. And so, I think I've put this slide out before in the weeklies, but I think it's an important reminder to just have a look. I know it's slightly blurry there, but it takes you back to kind of 1940, I believe. And it's just a view of, like, people ask me, are we going to be in deflation? And I use deflation probably more loosely than it should be, from the perspective of, people think of that line, that zero line, right? Below zero deflation, above zero inflation, where I think generally more in rate of change terms, which we talk about often. So, that 8% inflation to 6% inflation, well, that's not deflation, but that's deflationary.
Mm.
And the market reacts to that 8 to 6, or that 6 to 4, or that 4 to 2, more so than it does to the minus, that absolute -2 level. So I thought this is a great chart to have a look at, that just kind of remember, like, the gold bars are the disinflationary periods, and that's what I think we're heading into here. And the kind of the drops below that zero line, those are the true deflation periods. Do we arrive there anytime soon? I'd say, who knows? It depends on how quickly they tighten rates. If they do go ahead and keep their foot hammered on tightening rates like they've projected right now, then we probably get deflation next year. I
Mm.
think that's a low probability. I think the higher probabilities, we just see that rate of change slow from 8 to 6 to 4.
Mhm.
And then we probably see somewhat of a stability around those levels until we get the supply chain dealt with, until Russia and Ukraine get settled and energy comes back online, and all of those things happen. But I think it's just a kind of important point of differential on the deflation disinflation piece.
Very interesting. Very interesting. Okay, great. Good ones today.
Thanks.
You did mention, just before we get on to what's going on this week coming up,
Mhm.
you said you did have a couple of questions roll in. Did you
Yeah,
want
so a couple of questions kind of around energy, because I've talked about it and I said, this is kind of the decider on what's going to happen. So if we had energy down this week, and oil and gas stocks are really kind of flat for the last quarter and down about 25% in the past couple of weeks as oil has rolled over. And so, the question that I'm sitting with now is, do we start to reaccelerate again, or does oil finally officially roll over? And so I think if we roll over, deflation happens very quickly and very soon. And that's probably gives the central bank the ability to hold off. So I think those two pieces are really interesting. So I've had questions around oil right now, and we're kind of really at that trend line right now, and it's broken kind of the short-term trade. And now the question is it going to hold or drop through? So that'd be something I'd be watching closely. So that's one of the things they've asked about. I had a couple of questions just about Warren Buffett's been buying. He's been buying energy names.
Right.
Yeah. And so, the thinking is, why is he doing that? And so if you look at Buffett historically, he's definitely not a macro strategist.
Mhm.
It's not what he does, not what he's interested in. He wants to buy a company that he can own probably forever.
Mhm.
So you look at Occidental Petroleum that he's been buying here, it trades at 5x earnings. I think that earnings number is not sustainable, but trades at
Mhm.
5x earnings, and that's probably why he's buying it. He looks at the business, I think if you think 10 years out, I think energy's probably going to be in shorter supply than it's been. And so he's looking at a 10-year runway, deploying money into this probably over, multi quarters and maybe multi years.
Yeah.
So that's much different than someone on kind of a shorter term thinker. Someone else asked about Druckenmiller, because Stan Druckenmiller is one of the few guys that has been able to make money every year for the last 35 years. And so Stan has a much different time frame and view. He owns Chevron and Freeport McMoran, a couple of those names, but he also has most of those positions covered. So he's got put protection on them. He recently spoke, I guess about a week and a half ago, talked about, I think the first leg of the bear market is done. But I think we're going to see these bear market rallies in a downward trajectory. So, I wouldn't look to him and say that, he's a real gauge on this is something that you won't want to own for a long period of time,
Right.
because he's been known to go from fully invested to fully cash in 24 hours. So, much different strategy between the two of them. So I'd say those are the questions that I've had that came through this week.
Okay, great. So what are we looking at to next week? Yeah.
Yeah.
Short week. Canada Day.
Oh yeah, right. Is it next
Canada
week?
Day. Yeah.
Okay.
Yeah.
Short week next week.
US markets will be open, obviously.
Yeah.
But they'll be closed on the following Monday, right?
Yes.
4th of July.
Yeah.
Sounds like a 4-day weekend for you and I, my friend.
Yeah, I haven't looked that far ahead. Yeah, I think more of the same. Let's see how the markets react to this. See what the volumes were like here at the end of the day. It does look like, generally kind of short covering. The signals are still that the trend is generally down in stocks, but as I say, bonds have ticked up, and so I'd be watching the two of those things. And energy is going to continue to be a pretty big wild card, and so lots to pay attention to. But as I said, I think last week, I think we're in this period, this next 4 to 6 weeks, that there's going to be a lot of activity to be made, and we're ramping up spending time on that. I did reference in the video last week that we're working on kind of a bond return profile that I was going to send out. I didn't quite get it finished up this week, but we'll get that out. We're working on that for next week.
Great. Okay, anything else before we head out for the weekend?
I think that's it for me.
Busy weekends. Okay. All right, everybody. So we'll button that up, and we'll see you next week.
Sounds good. Thanks, everybody.
Okay.
Take care.